Some companies have been around for centuries as market leaders. Just think of Coca-Cola, Walmart, or even Disney. They have been selling the same products, offering the same services, consistently generating profits, and adapting through countless economic cycles for over 100 years. But on the other side of the coin, we also have companies that have, not had the same luck. We can turn to Blockbuster, Dollar General, or even IBM. Some of these have not just lost the market leadership that they once had, but have even disappeared, as it was in the case of Blockbuster. But what is actually the difference between these type of companies? Well, the difference very easily lies in, as Warren Buffett calls it, their economic moat. A moat is a sustainable competitive advantage that protects a company's long-term profits and their market share from rivals. Remember those large medieval castles that you used to learn about in history class? Well, all of them had a very wide moat with a drawbridge protecting them from enemies. An economic moat, it's just the same. In the case of Walmart versus Dollar General, very simply, Dollar General, their only competitive advantage was that they had very low prices. Whereas in the case of Walmart, they're just very good at most things they do, but especially with their brand, their portfolio breadth, and the quality of their service, which are things that don't erode and actually make clients stay even if your prices are a lot higher. But why should we care about economic moats as investors? There are a few characteristics that companies with large moats actually tend to have, and these are very advantageous not only for the companies, but for investors. Number one is that these stocks actually have higher expected returns. We will dive into this along the video. But number two is that these stocks usually have reduced investment risk and lower volatility. Number three is that these companies usually have more predictable earnings, free cash flow generation, and even dividend payments, which rewards shareholders. Number four is that this actually allows them to use and actually leverage compounding power, which is where consistent growth actually allows that growth to become way higher over time as percentages accrue over time. Number five is that these companies are extremely resilient to economic cycles. And number six is their long-term competitive durability that has allowed companies such as Coca-Cola or Disney, as we saw, to be market leaders for over 100 years. Now, an economic moat can come in various sizes and various colors. Here are the 5 most common categories for how economic moats can actually surge, emerge, and benefit companies. Number 1 is the most common one for software companies, and this is called the network effect. Simply put, this is basically the larger user base you have, the more value you're able to generate to the users of that platform. Think of Instagram, think of YouTube, or think of TikTok. Any social media you think about has more value the more people that are in it. If you went to the first years of YouTube, you had very limited video options to look at. Most of them, let's be honest, were not really interesting. But if you're on YouTube now, since pretty much everyone is becoming a YouTuber, you have endless opportunities and an unlimited collection of content that can be useful for almost anyone in the world. As we can see, the network effect works in a way where once a certain number of users has been reached, it starts to grow exponentially. And then once it reaches a certain network size, then the benefit is already extremely high and more people will just keep joining. The bigger the network gets, the better its value proposition becomes compared to other offerings, and the more users that will eventually gravitate towards it. And just to illustrate some examples, we have many companies that are enjoying the network effect. Starting with Amazon. The more sellers on Amazon and the more buyers, well, the higher the value of the platform. If we think of Airbnb or even Booking, well, these companies were not valuable until a lot of hotels or a lot of rooms started appearing on their sites. And once this happened, a lot of users started gravitating towards their sites, and this just becomes a cycle. And last but not least, we can also think of Uber and all social media companies. Next, we have switching costs, and these are very powerful to deter new entrants. Have you ever signed up for a gym, and then when their promotions end and you have to pay the full amount, and you actually stop going as much as you used to go, you realize that you don't really need that gym subscription. So you call them in order to try and cancel your plans. But they hit you with a load of steps you have to do. You have to go to the office in person, you have to fill in a lot of documents, you have to prove your residence, and a lot of administrative stuff. Well, this is something that categorizes as switching costs or switching effort, where companies such as Planet Fitness make it very hard for you to leave. Well, as we can see, the relationship with the switching costs and the retention rate is positive, meaning that the harder the companies make it for users to switch providers, the higher the chance of users actually staying with that company get. And other common examples are, well, AT&T, Microsoft, and even Salesforce, where, for example, with Salesforce, it's not only that it's difficult to change, it's that you have to go through a whole migration process where you have to hire a bunch of consultants in order to migrate all of the data systems, and that is extremely expensive. As Van Eck states, powerful moats can be built on switching costs, which lock customers into a company's unique ecosystem and make it extremely expensive to move. Next, we have intangible assets, which includes everything like brands, patents, and any other intellectual property, which are some of the most basic forms of competitive advantage, but also the most effective. Because let's do a quick test. When you think of a mobile phone, I bet you initially think of Apple. When you think of sportswear, I can assure you that the first company that comes to mind is Nike. And even when you think of coffee, well, the first company that comes to mind again is Starbucks. These are very easy. But what about something like the 3-point seatbelt? The regular seatbelt that everyone has in their cars. Well, I bet you can't think of the company who created it and patented, right? I'll tell you. It's none other than Volvo. They created this system. Thankfully, they made it a public patent so anyone can use the design, but hadn't they done so, they could start earning money for every other company car in the world which decided to use their system. And this is a way that you can create competitive advantage, because before they made this public, no other car brand could include the 3-point seatbelt without paying Volvo. And the thing is that brands are the ultimate form of competitive advantage because they're built on emotion, which is the most powerful thing we have. These are extremely difficult to replicate, so even if Nike has been having a couple of bad years, we're still going to have them as the market leader in our head. Economic moat number 4 comes as cost advantages, and these can actually help maintain dominance over an industry for a very long period of time. And I think that if you studied anything related to business or economics, this is one of the most simple ones to understand. Because when you're actually operating a production plant, you have variable costs, which are unitary costs. The more you produce, the more of these costs you will have. And then you have fixed costs, which will stay the same regardless of how much you produce. So the theory here is that the more units you start to produce, the more you will be able to spread those fixed costs, which overall will drive your unitary costs down. And this, as we can see, is called economies of scale. Well, eventually, the theory states that you will reach a point of constant returns to scale, where you've started to produce so much that even though you're still spreading your fixed costs even further, complexity is starting to be introduced into your production plant, which does not really benefit or damage your unitary costs, until you reach a specific cost where you start to experience diseconomies of scale, where the more you produce, the more expensive it gets for you to actually produce. However, the idea is that companies actually stay and enjoy in economies of scale, and they're able to produce their products at a way lower cost than all the competitors, which can give them the option to leave their prices the same and just enjoy stronger margins due to a lower cost of production, or they can just maintain their margins stable but lower their prices in order to become more competitive and attract more customers. So imagine we had two companies here. Well, if company B is able to produce their products at half the cost than company A, it's clear that they will be able to charge less and earn more from every single product that they make. So this will act as a competitive advantage, an economic moat, and a barrier to entry for other companies like company A. And now last but not least, we have the efficient scale. And this basically argues that in saturated or concentrated markets, these may actually organically limit entry opportunities due to a very limited profitability. So think about any market. Let's think of flower stands in a very small town. There is a very limited population and there are very limited sales for flowers. Now flowers, you cannot export them outside your town because they won't get there fresh. And at the current moment, there are two companies which rule over the town. Company A has a 60% market share and Company B has a 40% market share. Despite one being way larger, they are both profitable at the moment. Now let's introduce another company into the market. Well, Company A and Company B become a bit smaller with 45% and 35% market shares, and Company C accumulates 20%. Company C is still profitable, but just slightly. But now imagine the same market, same size, but we add even more companies to it. Well, it gets to the point where since the pie is the same, every single slice becomes a lot smaller. Two new entrants, Company D and Company E, have such a low market share that they are actually unprofitable. So this, by itself, means that Company D and Company E will not stay in the market for a long time, as they cannot fund their operations and will have to eventually leave. Well, this shows how the efficient scale works, because after Company D and Company E leave, no other companies will try to join the market, as they know that there is not enough profit to be made with more than 3 companies. But remember at the start where I told you that economic moats actually do show better returns than normal companies? Over here, we can show a 10-year return for, on the one hand, the S&P 500, showing the total US stock market, and on the other hand, SPHQ, which is the S&P 500 quality ETF. Now, this is not exactly an ETF which shows those companies which have a defined moat, because at the end of the day, this is a sort of subjective topic. However, this ETF tracks stocks with the highest quality score, which are based on their return on equity, their accruals, and their leverage. Well, in this case, over 10 years, the SPHQ managed to outperform the S&P 500 by over 16 percentage points. And I know this is not a lot, but this is an index, and this is not perfect. Now, just to give you some examples of the holdings in the SPHQ index, we have Apple, Costco, which has some of the most wonderful brand recognition and customer loyalty that there is, MasterCard and Visa, then we have Coca-Cola, which we discussed at the start, Salesforce, which has very high switching costs, and even Caterpillar, which is the clear leader due to their brand, their quality, their cost advantage, and other types of economic advantages. What KPIs can you look at to identify companies with wide moats? Well, I'm not going to give you a full list because I for sure would be leaving some behind, but I'm going to give you 4 of the most important when it comes to quantitative analysis. But the first quantitative factor could be their net margin evolution. Now, you want a company which is able to maintain a very solid net margin for a very long time, and it's even better if these margins actually increase over time. Number 2 is their free cash flow evolution. Yes, earnings are good, but free cash flow is what is actually returned back to the shareholder. So when companies have a free cash flow evolution that looks like this, which is extremely predictable, growing, and very stable, meaning that there are no large ups and downs. This means that this company could have a very wide moat. Next is their return on capital employed or their return on invested capital. You want companies that are showing very high ratios for a very long time period, because this means that they're extremely efficient at investing their capital, and you also want to see decreasing churn rates. This is essentially because you want less customers being able to leave your client because of whatever reason. It can be because they're the best producer out there, because there are no other solutions, or because there are just high switching costs. But this shows you that revenues and profits will start to be more predictable, essentially showcasing the economic mode of the company you're analyzing. But now, it's extremely important. An economic mode is not defined when a company has either of these. A company must have all of these all together, along with other qualitative factors such as pricing power, industry characteristics, and many, many more factors. But now, on the other hand, economic moats don't last forever, and if you're investing in companies just because of their economic moat, you should be keeping an eye out for any of these factors, which are, we can call them red flags for identifying economic moats that are deteriorating. So for example, if net margins are declining, if their company is losing market share, if the churn rates are increasing, if they have an inability to raise prices or their products are becoming sort of commodities, then if there's technological disruption in the industry and your company, you see that they cannot properly keep up with it, if the efficiency ratios such as return on capital employed or return on invested capital are decreasing, and if there is an increase in maintenance capex, as this affects free cash flow directly. And now, of course, we have some examples of companies that are having their moats eroded, such as Adobe, Intel, AT&T, Boeing, Disney, General Motors, Bank of America, CVS, Macy's, and even Dropbox. Now, all these companies can tick at least one of the boxes that we have described previously. For example, Adobe is facing technological disruption. Intel is losing market share. AT&T has faced commoditization. But I think that you get the point. Now, what is my investing strategy after this analysis? Most long-time viewers will probably know that I have two main portfolios. One where I invest in ETFs and it's more stable, and another one where I focus on individual stock picking. And there, my investment strategy is to choose companies which have strong competitive advantages that can last for tens and hundreds of years. Because at the end of the day, I stick to what Warren Buffett said, which is that it's far better to buy a wonderful company at a fair price than to buy a fair company at a wonderful price. Now, having said that, thank you for watching. As always, this has been the Cashflow Compounder. Join the free Patreon for extra content, and I will see you on the next one.